What if I told you there's an ETF right now paying over 10% monthly? And it's not some sketchy penny stock fund. I'm talking about institutional grade income, the kind that could generate $500 a month from a portfolio you can actually build. But here's what nobody's telling you. High yield doesn't always mean high income, and that's exactly where most investors get it completely wrong. In the next 15 minutes, I'm breaking down 7 ETFs, 3 focused on pure income, 2 built for growth, and 2 that do both. By the end, you'll have a framework that changes how you think about building wealth through ETFs. Let's get into it. Before we dive into the funds, we need to address the biggest mistake income investors make. They chase yield. They see 12% and think that's better than 8%. But yield is just one piece of the puzzle. What matters is total return. That's your dividend income plus any price appreciation. An ETF paying 8% that gains 10% in value gives you 18% total return. An ETF paying 12% that drops 5% in value only gives you 7%. Think about it like this. Would you rather have a rental property generating $50,000 a year in rent but losing $100,000 in value? Or one generating $30,000 in rent while appreciating $70,000? The math changes everything. So as we go through these 7 ETFs, I'm not just showing you the yield, I'm showing you the full picture: risk, tax efficiency, total return, and who each fund is actually designed for.
Real quick for anyone new to this, an ETF is an exchange-traded fund. Think of it like a basket of stocks or bonds that trades like a single stock. Instead of buying Apple, Microsoft, and 50 other companies individually, you buy one share of an ETF that holds all of them. You get instant diversification, professional management, and you can buy and sell during market hours just like any stock. The ETFs we're covering today range from conservative bond-like funds to more aggressive equity strategies. Some pay monthly, some quarterly, some focus on capital appreciation, others on income. The key is understanding what you're actually buying, not just chasing the highest number on a screen.
Here's the framework I use to evaluate every income ETF. First, yield. What's the current distribution rate? But more importantly, is it sustainable? Second, total return. Over 1 year, 3 years, 5 years. Is the fund actually making money or just paying out distributions while the share price bleeds? Third, risk profile. How volatile is it? What happens during market crashes? Lower volatility means you can actually sleep at night. Fourth, tax efficiency. Are the distributions qualified dividends taxed at 15% or ordinary income taxed at your full rate? In a taxable account, this matters enormously. And fifth, time horizon. Is this a fund you hold for 6 months or 16 years? Different strategies for different goals. Keep these 5 factors in mind as we go through each fund.
Let's start with the JP Morgan Equity Premium Income ETF, ticker JEPI. This is probably the most popular income ETF in the market right now, and for good reason. JEPI currently yields around 8%. It pays monthly, and it's designed to give you income with lower volatility than the S&P 500. Here's how it works. The JP Morgan Equity Premium Income ETF holds a portfolio of large-cap stocks, but instead of just sitting on them, the fund sells call options against those positions. When someone buys a call option from the JP Morgan Equity Premium Income ETF, they're paying a premium for the right to buy the stock at a higher price. The JP Morgan fund collects that premium every single month. That premium becomes your distribution. The trade-off? You cap your upside. In a raging bull market, the JP Morgan Equity Premium Income ETF will underperform a straight S&P 500 fund. In 2025, this fund returned about 8% total, while the S&P did over 20%. But in choppy or down markets, the JP Morgan fund tends to hold up better. The distributions are mostly return of capital, which has tax advantages in taxable accounts. But they're not qualified dividends, so in an IRA or Roth, you're golden. In a taxable account, your tax bill might be higher. Who is the JP Morgan Equity Premium Income ETF for? Conservative investors who want current income without huge swings, retirees, people building passive cash flow. This is not a wealth-building fund. It's an income-generating fund. Who is it not for? Anyone under 40 trying to maximize long-term growth. Anyone who wants to beat the market. This fund is designed to generate income and smooth out volatility, not chase maximum returns.
Next up, the JP Morgan Nasdaq Equity Premium Income ETF, ticker JEPQ. Think of this Nasdaq fund as the JP Morgan S&P fund's tech-focused cousin. Same strategy, different holdings. The JP Morgan Nasdaq fund tracks the Nasdaq 100, so you're getting heavy exposure to Apple, Microsoft, Nvidia, Tesla, Amazon. Then it sells call options on those positions to generate income. Right now, the JP Morgan Nasdaq Equity Premium Income ETF is yielding around 10 to 10.5%, significantly higher than the S&P version because tech stocks are more volatile. More volatility means higher option premiums. Higher premiums mean bigger distributions. But here's the catch. Tech is a double-edged sword. When tech rips higher, this Nasdaq fund gets left behind because you've capped your upside with those call options. When tech crashes, the fund falls, but the distributions help cushion the blow. In 2025, the JP Morgan Nasdaq fund delivered roughly 14% total return, which is solid, but still laughed the Nasdaq's monster year. The monthly distributions are consistent, ranging from about 50 to 55 cents per share recently. The tax treatment is similar to the JP Morgan S&P fund, best held in tax-advantaged accounts. If you love tech but want income instead of pure growth, this is your fund. Who is the JP Morgan Nasdaq Equity Premium Income ETF for? Tech-savvy income investors, people who believe in the mega-cap tech story but want monthly cash flow, younger investors who want some income without going full boomer dividend stocks. Who is it not for? Pure growth investors, anyone who wants to maximize tech exposure during a bull run, anyone uncomfortable with monthly distribution variability.
Now we're talking about the NEOS S&P 500 High Income ETF, ticker SPYI. This is the newer, more aggressive option compared to the two JP Morgan funds. The NEOS fund yields around 11 to 12% right now. It also uses a covered call strategy on the S&P 500, but with a twist. The NEOS S&P 500 High Income ETF uses 0-day to expiration options and a more dynamic approach that can capture more upside. Here's what makes the NEOS fund different. In 2025, this ETF captured about 98% of the S&P 500's upside while still delivering that 11% yield. That's borderline magic in the covered call world. Most covered call funds give up way more upside. The reason? The NEOS strategy is more active. They're not just mechanically selling calls every month. They're adjusting strike prices, using index options with favorable tax treatment, and harvesting tax losses along the way. Speaking of taxes, here's the big advantage. A large portion of the NEOS S&P 500 High Income ETF's distributions are classified as return of capital, which is extremely tax efficient. You're essentially getting your own money back tax-free, deferring the tax bill until you sell. The trade-off? The NEOS fund is more complex. The distributions can be more variable month to month, and because it's relatively new, launched in 2022, we don't have a full market cycle of data yet. Who is the NEOS S&P 500 High Income ETF for? Income investors who want to stay fully invested in equities, people in high tax brackets who need tax-efficient income, anyone looking to replace the JP Morgan S&P fund with something that captures more upside. Who is it not for? Conservative investors who need predictable monthly income, anyone uncomfortable with a newer, less proven strategy.
Let's shift gears. The Schwab U.S. Dividend Equity ETF, ticker SCHD. This is the gold standard for dividend growth investing. The Schwab Dividend ETF currently yields around 3.6%, way lower than the funds we just covered. But here's why it matters. The Schwab fund doesn't use options. It doesn't use leverage. It doesn't do anything fancy. It simply holds high-quality dividend-paying stocks. Companies like Chevron, Pepsi, Merck, Home Depot. Businesses with strong balance sheets, consistent earnings, and a track record of raising dividends year after year. The magic of the Schwab U.S. Dividend Equity ETF is total return. Over the past decade, this fund has crushed the S&P 500 with lower volatility. In 2025 alone, the Schwab Dividend Fund was up around 7%, but that doesn't include the growing dividends. Here's the real power. The Schwab Fund's dividend has grown at an average rate of about 5% annually. So if you bought it 10 years ago at a 3% yield, your yield on cost today is much higher. The compounding effect is insane. The distributions are quarterly, not monthly, but they're qualified dividends, taxed at the lower capital gains rate, perfect for taxable accounts. Who is the Schwab U.S. Dividend Equity ETF for?
Long-term investors, people who understand compounding, anyone building a dividend snowball. This is a set-it-and-forget-it fund for the next 20 years. Who is it not for? Anyone needing high immediate income, anyone looking for monthly distributions, impatient investors who want results now.
Now we're getting into higher risk, higher reward. The Van Eck BDC Income ETF, ticker BIZD. BDC stands for Business Development Company. These are firms that lend money to mid-sized private companies. Think of them as private equity for income investors. The Van Eck Fund holds a basket of these BDCs. Current yield? Around 11 to 12%, paid quarterly. This is legitimate high-yield income. But let's talk risk. BDCs are lending to companies that can't get traditional bank loans. Higher risk borrowers mean higher interest rates. Higher interest rates mean higher income for the Van Eck BDC Income ETF. But if the economy tanks and these companies default, this fund gets hit hard. In 2025, the Van Eck BDC fund was down about 8%, while the S&P was over 20%. That's the volatility you're signing up for. But that 12% yield helped offset some of that pain. Here's the interesting part. The Van Eck BDC Income ETF uses total return swaps for about a third of the portfolio. This creates synthetic leverage. You get amplified returns in both directions. When BDCs are hot, this fund soars. When credit spreads widen and defaults rise, the Van Eck fund bleeds. The expense ratio is also brutal at 12.86%. But that's because the underlying BDCs themselves have built-in fees. You're essentially paying for active middle market lending exposure. Who is the Van Eck BDC Income ETF for? Sophisticated income investors who understand credit risk. People who want exposure to private credit through a liquid ETF. Anyone with a high risk tolerance and a long time horizon to ride out volatility. Who is it not for? Conservative retirees. Anyone who panics when their account drops 10%. Anyone who doesn't understand what they're investing in.
Last one, and this might surprise you. The SPDR S&P 500 ETF, ticker SPY. Or VU, Vanguard's version, same thing. Current yield? About 1%. Pathetic compared to everything else we covered, right? Wrong. Here's the reality. The SPDR S&P 500 ETF gives you pure equity exposure to the 500 largest U.S. companies. No gimmicks, no options, no fancy strategies. Just ownership in American business. Over the past decade, the S&P 500 ETF has averaged about 12 to 13% annual returns. In 2025 alone, this fund was up over 20%. That crushes almost everything else we talked about. The 1% dividend gets reinvested automatically if you set it up that way. The real magic is capital appreciation. Your wealth compounds through share price growth, not distributions. The tax efficiency is unbeatable. Almost no turnover means almost no capital gains distributions. Qualified dividends at low rates. Perfect for taxable accounts if you're building long-term wealth. Who is the SPDR S&P 500 ETF for? Long-term wealth builders. Anyone under 50. People who don't need current income. Investors who understand that growth beats income over decades. Who is it not for? Retirees needing cash flow. Anyone with a short time horizon. Emotional investors who freak out during 20% corrections.
So let's compare. If you put $100,000 into each of these funds, what would your income look like? JP Morgan Equity Premium Income ETF at 8%, $8,000 annually, $667 per month. JP Morgan Nasdaq Equity Premium Income ETF at 10%, $10,000 annually, $833 per month. NEOS S&P 500 High Income ETF at 12%, $12,000 annually, $1,000 per month. Schwab U.S. Dividend Equity ETF at 3.6%, $3,600 annually, $300 per month, but growing every year. Van Eck BDC Income ETF at 12%, $12,000 annually, $1,000 per month, with higher risk. Janus Henderson AAA CLO ETF at 5.3%, $5,300 annually, $442 per month,
rock solid. SPDR S&P 500 ETF at 1%, $1,000 annually, $83 per month. But your portfolio might be worth $130,000 in a few years. This is the trade-off: high income now versus high growth later. Let's make it practical. How much do you need to generate $500 per month? With the JP Morgan Equity Premium Income ETF at 8%, you need $75,000. With the JP Morgan Nasdaq Equity Premium Income ETF at 10%, you need $60,000. With the NEOS S&P 500 High Income ETF at 12%, you need $50,000. With the Schwab US Dividend Equity ETF at 3.6%, you need $167,000. With the VanEck BDC Income ETF at 12%, you need $50,000. With the Janus Henderson AAA CLO ETF at 5.3%, you need $113,000. With the SPDR S&P 500 ETF at 1%, you'd need $600,000 just for monthly income, which isn't the point of the S&P fund anyway. This is why portfolio allocation matters so much. You probably don't go all in on one fund, you blend them.
Here's an example allocation for a balanced income and growth portfolio of $100,000. 30% Schwab US Dividend Equity ETF, $30,000. Long-term Dividend Growth Core Holding. 20% JP Morgan Equity Premium Income ETF, $20,000. Stable monthly income with downside protection. 20% NEOS S&P 500 High Income ETF, $20,000. Higher income with equity upside. 15% SPDR S&P 500 ETF, $15,000. Pure growth exposure. 10% Janus Henderson AAA CLO ETF, $10,000. Ballast for stability. 5% VanEck BDC Income ETF, $5,000. High yield SPICE with higher risk. Your annual income from this portfolio? About $6,500 to $7,000, roughly $540 to $583 per month. Plus, you're capturing long-term growth through the Schwab Fund and the S&P 500 Fund. You adjust the percentages based on your age, risk tolerance, and income needs. Younger? More S&P 500 and Schwab. Older? More JP Morgan and Janus Henderson. Here's an example allocation for a balanced income and growth portfolio of $100,000. 30% Schwab US Dividend Equity ETF, $30,000. Long-term Dividend Growth Core Holding. 20% JP Morgan Equity Premium Income ETF, $20,000. Stable monthly income with downside protection. 20% NEOS S&P 500 High Income ETF, $20,000. Higher income with equity upside. 15% SPDR S&P 500 ETF, $15,000. Pure growth exposure. 10% Janus Henderson AAA CLO ETF, $10,000. Ballast for stability. 5% VanEck BDC Income ETF, $5,000. High yield SPICE with higher risk. Your annual income from this portfolio? About $6,500 to $7,000, roughly $540 to $583 per month. Plus, you're capturing long-term growth through the Schwab Fund and the S&P 500 Fund. You adjust the percentages based on your age, risk tolerance, and income needs. Younger? More S&P 500 and Schwab. Older? More JP Morgan and Janus Henderson.
Now I want to hear from you. Which of these 7 ETFs are you most interested in? Are you Team Income, Team Growth, or Team Blend Everything Together? Drop a comment below. If you found this breakdown helpful, smash that like button and subscribe. I'm breaking down more ETFs, dividend strategies, and income portfolios every week. And if you want me to go deeper on any one of these funds, let me know. I'll make a full deep dive video on whichever one gets the most requests. Thanks for watching. See you in the next one.